Hello, everyone. Welcome to the lecture on financial statements. And tonight's going to be a very interesting way to go about it. I'm going to kick it off and talk about just a really high-level overview of financial statements and how we use them in finance. But then we're going to have a guest lecturer tonight, a really good friend of mine, Ron Herbert, who's the CFO at Fast Signs, a company I'm sure all of you have heard of, particularly if you've had to get any kind of signage or anything like that for your business. He's also formerly the CFO at a company called FairPay, which was in the healthcare reimbursement and expense control business. Is that a right way to say that? Technology enabled, I would say. And before that, he was the CFO at a public company called Health Access. So his last 3 CFO roles, he's been in both public, private equity, and venture roles. And he and I worked together and built a consulting practice together focused on CFO and controller activities. So for small hyper-growth businesses, usually. We did other things too, but that's most of what we spend our time on, a lot of venture capital related stuff. So the point being is that he's also got a BBA in accounting from SMU, so he really knows what he's talking about when it comes to financial statements and how they're used in finance and how we use them to be effective in finance. And so I'm just going to jump right into it and tell you that, you know, you have to learn how to read a book. You have to learn how to read a map. And I think you need to learn how to read financial statements as well. It's not intuitive. I know many of you have had accounting 101, 102, whatever those accounting courses, the prerequisites you've had, but largely they've taught you how to build them, how to audit them, how to prepare a tax return. We're focused on, okay, what does it say? What does it mean? How do you do it? How do you manage it? So if I was going to be focused on financial statements and I'm going to be looking at them for information, I want them to tell me something. So what is it that I want them to tell me? Well, the first thing I want to know is how much money did I make? All right. Well, I think what else would I want to know? Well, after I've made the money, I think I want to know how much money do I have, or how many assets do I have, how many buildings or equipment, and what's the depreciated value of that, not just what I paid for it, but what do I think that I have, and what else would I want to know? Well, frankly, if I did that, I would want to know how much do I owe. So do I have a bargaining money? How much do I owe somebody? How much money's been invested in the company and equity? So it's kind of like owing somebody some money. So, you know, where am I? And what else would I want to know? I would want to know, after all of that, how much am I worth? So what's the net worth of this business after, you know, I've made my money, I've either left it in or taken it out? How much did I make? What do I have left over? Did I leave it in the business? Do I owe anybody? And after it's all said and done, what is this business worth, right? So those are the kinds of things you could look to learn about a company simply from reading its financial statements. Now, in this course, as you know, most of the financial statements we use are derived off of the way a public company would do it, because a public company has really good, plentiful, reliable, verifiable data, where private companies, it's much harder to get to reliable data for academics and coursework. So let's take a look here. So if this is what I want to know, what else do I want to know? How much did I make? Well, in the financial statement world, that's going to come in the form of an income statement. We call it a P&L in the vernacular, profit and loss statement. So how much did I make? Well, what else did I want to know? Remember, I wanted to know how much do I have? Well, it's the asset section on the balance sheet. Pretty simple. Then I want to know how much do I owe, which is the liability section on the balance sheet. And lastly, and in many cases, most importantly, how much am I worth? Well, it's you know, the equity on the balance sheet. And frankly, I think the most underused and one of the most valuable financial statements is the statement of stockholders' equity. One of the things that I look at, if I'm going to look at a business, I go straight to statement of stockholders' equity to see what's been going on as it relates to the ownership of the business. So we're going to look at these things, and we're going to try and figure out a few things through this. But one of the things is, what do they say? You can look at a financial statement, and are they saying that we're doing well, are we doing poorly, or are we doing great? What are they telling us? What do they not say? Well, they may tell you how much your inventory is, but they're not going to tell you that your used car inventory is turning really fast and your new car inventory is turning really slow if you just have one line item that says inventory. So, what do they not say is important. What do they infer? They would infer that you are a healthy company or you're not a healthy company. They may or may not be accurate, but they would certainly infer that. And then another thing that's kind of crazy that you might not have thought about is how many types and sets of financial statements would you actually have? Well, in my world, you have at least 4, if not, but we're going to talk about 3 here, which is you have the real honest-to-goodness books, which is GAAP, audited, published financial statements that you would use for all your compliance activities. If you're a public company, you report to the Securities Exchange Commission. If you're a private company, you give those to your banks and other lending sources, your real true books. But frankly, as we've said before, there's a whole other totally legitimate set of books, which are your tax books. And they are not only your federal returns, but you'll have state returns. In my company alone, I think we filed 150 state tax returns last year. And we only have 50 states. Now I want you to think about that for a minute. So there's also property taxes, sales taxes, all have their own sort of financial reporting requirements that are not necessarily directly correlated to your GAAP set of books, because they're done differently. Depreciation schedules are differently, values are done differently. And then management books, which are operationally focused, which are utilization rates or flow-through rates or any of those kinds of things. So those are the kinds of things that you might see. And then I obviously like to look at things on a cash basis as well, but that's not every CFO does that. At this point in time, I'm going to turn it over to Ron Herbert, and we're going to bring the smart guy in, and he's really going to tell you how this works. And I'm going to listen in on the lecture, and occasionally I might, lob in a question or a comment or something like that he will respond to. And here's Ron.
Thank you, Scott. It's a pleasure to be with you guys tonight, and hopefully I can share some experiences with you that are practical and help you see the eyes through a couple of different CFO experiences, as well as both through the eyes of Professor Wheeler and myself. And so Scott did a good job of discussing the various types of financial statements. As we then move into the book side of the world, the most common way to see financial statements for us as individuals is to be able to go out and read the 10K of a public company. All of us that are currently in private companies, we have our sets of financial statements, but those aren't available for the public to see. But those public companies are required to file with SEC.gov, gives us the opportunity to go in and see all the details of their financial statements. And so those financials that are on SEC.gov, also various other internet tools and websites, are all focused on the Form 10K, the annual report of a public company. And as well, they're required quarterly to file their 10Qs, which is a quarterly update to that 10K. So there are a couple of things in particular that you want to focus on with the annual report on Form 10K. There's qualitative discussions of what's going on within the business. And so the more important, or one of the most important parts of that, is understanding what's in the management discussion and analysis, called the MD&A. And so this is an opportunity for management to explain what's going on in the business. It's text, it's explaining the numbers, and it breaks down the various aspects of all the financial statements, and we'll walk through what the financial statements look like here in a minute. But this is the opportunity for management to describe to the reader, to the investors, what's going on within the company. And the intent is to explain not only what's happened historically, but they're also providing information on how they see the future, that tends to be a little bit more limited in discussion because they don't want to get in trouble for making predictions that don't come true. But if there are trends or other things that they see going on in the business that are reasonable or that an investor would reasonably want to know, they're to be including that in the MD&A. You'll also, in a private company environment, you'll see MD&As as well. They tend to be less focused on following the rules, but providing investors with discussion of what's going on in the business. Another section that you'll see within the 10K is called risk factors. And so this is a place for management to go through and basically explain things that they believe are the what could go wrong questions. A lot of times it starts to sound like a little bit of CYA, but it's to provide a balance, because a lot of times in MD&A, management discussion and analysis, can be focused on the positives going on in the business, and so this is a way to talk about things going on in the business that could be a concern, things like commodity fluctuations or other things that we see going on in markets, maybe something that they want to highlight, things that may cause future decline in revenue, etc. So those are the qualitative aspects. The quantitative aspects are really where we'll spend a lot of time talking in this session. And so Scott did a good job of walking through what those quantitative statements are. You start with the balance sheet, and that provides a snapshot of the firm's financial position at any point in time. You also have an income statement, also called a profit and loss, P&L, or a statement of operations that summarizes a firm's revenue and expenses over whatever period of time is covered. In a 10K, it's the annual period, the 12 months ended. Most companies have a December 31st year end, so usually a January through December time frame. Next, you have a statement of cash flows, and this shows the impact of the activities on cash flows. And this is one that I tend to focus on a lot. There are a lot of things like judgmental estimates and accruals and all that, amortization, that can change the look of an income statement. But if you want to really understand how the cash is flowing in a business, you'll spend a lot of time in the statement of cash flows. The next statement is a statement of stockholders' equity, and so how much of the firm's earnings were retained or paid out as dividends. And then you get into the footnotes that describe all aspects of the accounting used by the company and gets into detail explanation of things that happened over the course of the year. So let's look at a balance sheet. All of these examples that we show are comparative, and the examples we're showing are comparative to a prior year, which is indicative or is helpful from a standpoint of financial statements are not, reading financial statements is not about focusing on a particular column, but it's taking everything as compared to what. And so what you'll see as we walk through these financial statements is there's a lot of comparison between the financial statements to really understand what's going on within a business. But for now, let's focus on the balance sheet, and we'll start with the assets. So, in this case, you have a classified balance sheet, and we start with current assets. So you can see the subtotal for current assets. Within current assets, we start with cash, and then you have categories for your assets going in order of what is most easily or most quickly converted to cash. So you start with cash, you then have your accounts receivable, net of any allowances. Then you move into things slightly less liquid like inventories, and within 30 to 60 days, you're usually collecting your receivables. Inventories can be in your warehouses for months at a time. And so those tend to be the key components of current assets. You then walk down the balance sheet asset section and you get into fixed assets. So what equipment do you have? What buildings do you have? And you can see we've got the abbreviation PP&E for property, plant, and equipment. And within that, you then have a deduction or a reduction to fixed assets for depreciation. And so when you buy fixed assets, you put them on your balance sheet at whatever you paid for them, and then over the useful life of those assets, you're depreciating and reducing the net value over time. That then gives you net fixed assets, and the combination of then everything that we've talked through, your current assets, your fixed assets, in this example gives us total assets. Now I'll pause here and go into some detail as we look at the comparatives. Again, it's important to think about what's going on in the business. And so in this particular example, you see accounts receivable are increasing. And you might ask yourself, well, is that a good thing or is that a bad thing? And I think most people would look at accounts receivable increasing and assume or presume that that's a positive. You may also look at inventories going up and presume that's a positive because you're adding to the things that you have, and fixed assets are going up as well. What you have to be cautious about is any particular item or any particular assumption you have to make, you have to validate with other things going on other sections of the income statement. And what I mean by that is when you look at an increase in AR, you have to think to yourself, is that driven by an increase in sales? Then that's probably a good thing. Or is it driven by customers paying more slowly? And so that would cause you concern. Inventories increasing, is that a function also of increasing sales and increasing turn in inventories? Or is that a function of a company perhaps built up too much inventory and it's getting stale and sitting there? And so those are the types of things that keep in mind as we walk through these slides, these kind of trends that we're seeing. We'll talk about reasons for the AR increase. We'll talk about potential reasons for inventories increasing, and then what's happening with fixed assets. So the second section then of the balance sheet are your liabilities and your equity. And so here it's the flip side. It's instead of what you have, it's what you owe. The liability section of the balance sheet is broken down in terms of current liabilities and non-current liabilities. Your current liabilities are things that are generally due within a year, and so certainly you can imagine accounts payable, you get invoices in, those are generally due within 30 or so days. Notes payable are many times current portion of long-term debt. That's what you owe back on your debt within the next year. Accruals, whatever invoices you have in hand at the end of any particular accounting period don't represent all the liabilities you have. You probably know that you've incurred expenses for things. Maybe you have bonus accruals or various other estimated liabilities that you need to accrue for. And so that is where these appear to give you a full picture of what those current liabilities within the company are. And so after you've covered the current liabilities, you then move into non-current liabilities. And in this particular example, we're just focusing on long-term debt. And so this could be an example of perhaps this company has $1.3 million loan that it took out, which is the combination of the notes payable line as well as the long-term debt. And so the $636,000 represents what's due within the next 12 months, and then $723,000 in long-term debt is what is due then 12 months and beyond from now, 13 months and beyond from now. Then after your liabilities, you work into your stockholders' equity. And so here you have common stock in this example. If you have any preferred stock issuances, that would appear as well. And then you have your retained earnings. And we'll see in a minute that there is one of the statements we talked about before is a detail of what goes into equity, the various ins and outs. But for now, we'll just focus on the balance sheet in totality. And so thinking at some of the comments that we made earlier, here let's keep in mind accounts payable is going up quite dramatically. And so you could ask yourself, good thing or bad thing? We probably don't have enough information at this point to really say. We can see that both current portion of long-term debt, or the notes payable, went up pretty dramatically. We can see the accruals went up dramatically, and we can see long-term debt went up dramatically. Just from these statements alone, I don't think we have enough information to make any qualitative assumptions or decisions, but it's important for us to note that the total liabilities have gone up dramatically. And then we look at retained earnings has dropped quite a bit. And so those are things we need to keep in the back of our mind as we move forward. The next statement we come to then is the income statement. And this is really the statement I think most people tend to focus on as to the health of the business. And so the income statement, you can see this one is a comparative income statement as well. It works through, what were our sales, what were our cost of goods sold, and then what were our operating expenses. We then work down through the net of those numbers, gives us total operating, or the total of cost of goods sold and operating expenses gives us our total operating expenses, excluding depreciation and amortization. To a lot of people, particularly in private companies, depreciation and amortization is an important thing that gets removed essentially from looking at the profitability of a company because they look at the fixed assets as an investment in the company as opposed to a measure of the cash flow. And we'll see that on the cash flow statement, and I'll come back to that. But that's just an important concept to be thinking about, is depreciation and amortization are typically looked at separately. And so you see we then have the expense for depreciation and amortization that gets deducted. That results in a line for operating income. We then back out or reduce for interest expense. That gives us earnings before taxes. Build in the provision for taxes to be paid, and then that gives us net income. And so as we look through this statement, thinking back to some of the comments we made on the balance sheet, we see that sales have grown dramatically. And so thinking back to accounts receivable going up, those seem to be trends that go hand in hand. Cost of goods sold goes up dramatically as well, and you might look at that and say, well, that's what I would expect to happen when I'm looking at that type of sales increase, and you're absolutely right. A piece of information that you don't see here is what is cost of goods sold as a percent of sales. And when you do that calculation and you have that information in front of you, you see that cost of goods sold in 2010 was 17% of sales, and it declined to 8% of sales in 2011. And so that would be a flag to you to really look at what's going on in the business and the cost of goods sold, the balance sheet. Corollary to cost of goods sold is going to be your inventory. And so there we saw inventories were going up previously, but our margin is dropping dramatically. And so we need to keep that in mind. As we look at operating expenses, those go up. Is that a function of just increase in sales, or are operating expenses growing too quickly? I did the math on those. 2010, operating expenses were 10% of sales, 2011, 9%. And so to me, that doesn't raise a red flag. That's your expenses as a percent of sales went down slightly, and that's what you would hope for. And so then as we work through to operating income in particular, you see we generated a loss in 2011. Thinking back to our comments on COGS, you can see that the decline in the margin coming from the sales and the higher cost of goods sold really created a problem for the company that resulted in the net loss for the year. And so those are the types of things that you want to be thinking through as you're reading these. Again, they go hand in hand, and one statement by itself doesn't give you the full picture. Nonetheless, when you look at the income statement and you see a loss, that helps to point you to areas that you need to dig into further to understand what's going on within the business. So then let's talk about some other aspects of an income statement particularly with public companies, they have a focus on earnings per share. And there are two measures of earnings per share. One is basic, and that's just taking net income off of that previous slide that we saw, or loss, and you're dividing by the number of common shares that are outstanding. And so it's just how much did the company make or lose per share of stock over that period of time. The other important measure, or the other one that will appear right below basic earnings per share, is diluted earnings per share. And so that's a calculation that takes not just the common shares that are outstanding for the company, but it also factors in things like preferred shares that are convertible, or warrants that are convertible into common shares, or stock options that executives and employees have, that if things continue to go well for the company, people will convert those types of preferred stock and warrants and stock options into common shares. And so it gives you a perspective of, if everybody converted those, what then would the company's earnings per common share look like? Something else that's important to me on the income statement is, what is the comparative? And in particular, when I look at the financial statements that we issue each month, so we're a privately held company, we are owned by a private equity group, and so our balance sheet, our income statement look somewhat different than what we walked through, in that there are a whole lot more columns. And what we're doing is we're comparing to prior year, we're comparing to budget, and we're also comparing to, you can call it LTM or TTM, which are last 12 months or trailing 12 months. And so that what that allows us to do, and our investors to do each month, is look at how we're doing versus how we did last year. How are we doing versus our budget? How are we doing on an adjusted basis, meaning last 12 months or trailing 12 months? And what that last 12 months measure gives you is it removes any seasonality. So if you're in a business that does really well in the summertime, maybe it's beach related, and you're comparing results, you don't want to be comparing summer months to winter months, and using a LTM basis really takes out the swings that occur with seasonality. The other way you can see income statements broken down, instead of by like cost of goods sold and a summary for operating expenses, you may see it by department or by categories. And this is what we do. In fact, at Fast Signs, is we have a subset of 4 different call it department subgroupings. And so we want to know how, since we're a franchising company, how are franchise sales and development expenses comparing to prior year budget and LTM? How's G&A, general and administrative expense, trending versus those? So you can look at it by department, or you can determine what categories, perhaps sales and marketing, general administrative, or whatever categories may make sense to the particular company you're working with. What are those right measures to give you the information that will help you run the business or understand the business? So we've talked a lot about the income statement. Let's move now to the statement of stockholders' equity. And this is different than what we've been looking at from a standpoint of, this is more of a roll forward schedule. And what this does is it starts with the balance at a beginning in time. So you can see it starts balances December 31st of 2010. And then it walks through what are the types of activities that occurred during the year. And the most common types of activities you'll see are, what was the net income or loss for the year? What dividends were paid? If there's stock issuances, anything like that would appear on this schedule. And when you factor in then the activity that occurs within the year, you get to your balance at the end of the year. And so you'll see, different companies have different subsections within equity of, in this case, we have common stock and we have retained earnings, and so it's relatively simple. You may see companies that have preferred stock. You may see activity that appears in here that are things like stock option or equity compensation. anything that would impact the equity accounts during the course of the year. And so you can see from this roll forward, the things that occurred in this example are we saw the net income that came straight off of the income statement, and so that feeds directly. Those numbers should always match to the income statement. And then you can see the company paid dividends. Even though they lost money, they paid dividends in this year. And so it walks you through the different activity that occurs within the equity accounts. We then get into probably my favorite financial statement, which is a statement of cash flows. Now, from a preparer standpoint, it's one of the more complicated ones to prepare, but this really gives management, investors, insight into what's going on within the business. And it is separated into 3 different sections, and we have 2 different slides that break the 3 sections apart. The first section is operating activities, and this is really where I focus. And so you start with net income, and we saw net income on the statement of stockholders' equity. We saw it on the income statement. It comes straight off of those statements, and so it's easy to verify that that's correct. It adds back depreciation and amortization because those aren't cash expenses. We'll see the cash outlay for property, plant, and equipment in a different section. And so we're adding back the expense that we took for depreciation and amortization. But then we work through what is the cash impact of all the increases and decreases in what we call the working capital accounts. And so we saw accounts payable went up. We saw that accruals went up. We saw that accounts receivable went up, and we saw that inventories went up. And so this is usually just the simple mathematical difference off of the balance sheet between those accounts. It's not always that way because there are often in the preparation of it adjustments and reconciliations to get to the final end number. But what you can see from this example is by increasing accounts payable, perhaps that was a function of paying vendors more slowly, we generated cash of $378,000. By increasing accruals, we had expenses that we hadn't yet paid for, and so that basically helped us increase our cash position by $353,000. Another way to think about that, if we had paid all our accounts payable and had the same balance as the prior year, if we had not increased our accruals and we had paid those more quickly, that would have been cash that would have left the business in this year. The other side then are the changes in the working capital asset accounts. We saw that accounts receivable went up, and so we did not collect the cash from those incremental sales. So that was a drain on our cash. And inventories, we had to pay for our inventories to come in. We saw how much the inventories increased. In particular, here on the cash flow statement, you can see the significant impact of when you don't collect on accounts receivable, it costs you your cash. And when you're paying to grow inventories, it costs you your cash. And those are some of the biggest numbers on the page, particularly the inventories. And so when you look at your net income adjusted for depreciation and amortization, and then the changes in working capital, you're able to see net cash provided by or used by operating activities. And so to me, this is just an absolute key measure of the business. This is saying this business in this year used cash. Its sales grew, but it lost cash. And conceivably, because they weren't managing accounts receivable as closely as they should have, or they built inventories too quickly, would be initial presumptions that I might make from looking at this. But when I see net cash used by operating activities, this negative $164,000, that's really a red flag to me. It's something that I really want to understand what's going on in the business and whether as an investor that's something I'm happy about or it's something that concerns me. The other sections of the statement of cash flows, and when you're looking at this on a 10K or various other financials, these two slides will be combined. They'll be on the same page generally. But the other two sections that we want to talk about on the statement of cash flows, the first of which is investing activities. And so this is mostly, and in this example, the only thing is how much did we pay for property, plant, and equipment. And so our capital expenditures for the year were $712,000. If you think back to the balance sheet, we saw PP&E increase quite dramatically. This shows us exactly how much we paid to add to that PP&E. And then the next section we get into is financing activities. And so this is showing us how did we pay for the things in the business. And in this particular case, we see notes payable increased, long-term debt increased, and we paid dividends. And so we had to essentially borrow a net of $826,000 to pay for the investing activities, the equipment we bought, as well as fund the cash loss from operations that we saw on the previous page. And then at the bottom of the schedule, you get a reconciliation. So what was the net of the three increases or decreases? So what's the net of the operating activities, the investing activities, and the financing activities? What was the cash at the beginning of the year? You add those together and you get to your cash at the end of the year. So those are the key financial statements that you'll see and that you'll focus on. We'll kind of change perspective for a minute here and talk about some of the things that have been going on in the environment related to preparation of financial statements. Sarbanes-Oxley Act of 2012, or 2002, it's hard to believe it's been almost 14 years since this went in place. But in 2001, we had activities going on of, you guys have probably heard of Enron and activities it was doing. It was basically hiding losses by creating complicated legal entity structures that it didn't have to show on the financial statements that it was publishing. Company went bankrupt, and that created all kinds of havoc of how on earth could a company that appeared publicly to be doing well go bankrupt, and it was from hiding or sheltering these legal entities that had no real purpose other than sheltering losses. Another example that happened in the exact same time frame was WorldCom. They were capitalizing expenses. And so what does that mean? Very simplistically, they were doing things like taking their monthly phone bill and they were calling that an investment in fixed assets rather than expensing it. And so they were grossing up their balance sheet. They were showing a balance sheet that was way too big, and people were getting excited about all the assets on the balance sheet, and ultimately there was no value to those assets. They were previous line charges that should have been expensed. And another one that occurred at the same time was Tyco, and Tyco was doing tons of acquisitions. They were paying large multiples, big dollars, and it appeared to be creating value for investors. Likewise, their balance sheets were growing dramatically and ballooning. And then there came a day of reckoning when they determined that the value they had on their balance sheet wasn't worth, these companies that they were buying were not worth what they had put on the balance sheet, and so they had to take huge write-offs. And so all these things happening at the same time cause regulators to say the public is losing faith in the financial reporting that's going on. And so what we need is we need officers of the company, the CEO and the CFO, to certify that their financial statements are correct and that they're not doing these things, that they're not sheltering losses, that they're not capitalizing things that should be expensed, that they're not grossing up their balance sheet for inflated acquisitions. And the penalty of officers certifying these financial statements, if they're found to be fraudulent, is CEOs, CFOs can go to jail for perpetrating these frauds. Likewise, the officers have to oversee an assessment of internal controls, and so this just created a lot of compliance required to be in the public domain and then slowed down a lot of companies that had wanted to become public so that they could either put in place these types of processes or just completely change their mind and stay within the private arena so that they don't have to certify or go through the compliance efforts to be able to assess the validity of their internal controls. Other hot topics that are going on, there's been a lot of talk over the last many years about IFRS. And so IFRS is International Financial Reporting Standards. The goal here is to provide comparability that if you're looking at a company that's based in the U.S. and operating under U.S. generally accepted accounting principles, are they required to do accounting in a way that's different than perhaps a company in the UK or in Europe or in China? And so the goal was to be able to provide one set of accounting rules across the globe that one particular investor could pick up multiple sets of financials and read them all the same way, rather than trying to understand, okay, in China, here's what the accounting rules are, and that's different than in South Africa. The accounting rules have these other changes, and in the U.S., there's a completely different set of rules, and some of it can be akin to what Scott talked about earlier with your different set of books. So you have, a published set of books, and then a federal tax set of books, and then a state tax set of books. And in many ways, that's kind of what this looks like, is when you have different rules, you have different outcomes that could happen of where you're based. So the goal was to synchronize accounting across the globe. That has lost a lot of the momentum that it had. And it wouldn't surprise me at this point if that has lost enough momentum that dies within the U.S. Reporting requirements in the near term. There have been some areas that we've gotten very similar U.S. accounting principles to international, but there's just not the drive that there was, say, 4 or 5 years ago to get them to match perfectly across geographies. The other thing, and this is something that I really focused on when I was in a public company, is disclosure overload. It's so easy for regulators to say, there are so many things we need to put in the financial statements about fair value of assets, how to account for derivatives, and what's ended up happening is financial statements and the footnotes in them have just ballooned over the years. They've doubled, tripled, quadrupled the number of pages that go in the footnotes, and there comes a point where some people feel you have to say, enough is enough. We need to go back to simple disclosures that the average investor can understand, because when you get into, and we as a group are reading about fair value of assets and the accounting for derivatives, most of that goes straight over all of our heads. But, there are experts in those space that those disclosures mean something to. Another thing that we think about with disclosure overload, or one way that has been tried to solve it, is, here we call it big gap versus little gap. Big gap would be public companies, people that are putting out their financial statements for public consumption, versus privately held companies. And so in my case with Fast Signs, since we're privately held, a lot of those disclosures and footnotes about fair values and derivatives are less important to our investors. They want to focus on what's the big picture, what are the really important accounting policies, and let's not get caught up in whether we're amortizing intangibles over 10 years, 12 years, what the fair value of those intangibles are, those types of things. And so little gap is a term for how do we simplify accounting for privately held companies. And that is kind of morphed over time. We've added within the SEC a private company council, and it's issuing its views and opinions on how we can simplify private company accounting, make it less complicated. As well, the AICPA has commissioned a financial reporting framework for small, medium-sized businesses, and so they're really focusing on how to create more efficiencies for these private companies that don't have all these nuanced and detailed requirements for disclosure? How do we make sure we provide good information to the right investors that they can read the financial statements and not be overloaded by nuances in detail? Another hot topic is impairment, and this goes back to some of what we talked about before, but it's important, particularly when you look at things like goodwill, intangibles, acquisitions, that is the value that's showing on the balance sheet appropriate, or is it overstated? So companies that are doing a lot of acquisitions, this is a huge hot topic for them of how do we make sure we're showing a good, fair value for those assets on the balance sheet. Another really hot topic is what's called non-GAAP, generally accepted accounting principles measures. EBITDA is really the biggest one that I see out there. When I was in the public company, we stayed away from talking about EBITDA. So EBITDA is earnings before interest, taxes, depreciation, and amortization. And it is the key measure that private companies, at least in my experience, focus on. And so in most cases, I would say EBITDA is almost synonymous with cash provided from operating activities. It is a proxy for what are the operations of the business generating from a cash flow perspective. And like we talked about when we were looking at the income statement, they get rid of depreciation and amortization. They look at the investment in property, plant, and equipment as just that, an investment. It's a cash investment, and the depreciation or amortization of it that appears on the income statement is not important to us. That's an investment in what the future operations are going to be, and what those investors want to focus on is what is the cash that we're driving from selling product, and then what is the cash outflow for servicing those revenues. And so what are we paying for cost of goods sold? What are we paying for our employees? What is the cash that's really being generated by the business? And so EBITDA is a proxy for that. The problem is, from a public company perspective, that is something that is not defined in GAAP. And so GAAP specifically defines what your revenues are, it defines what your expenses are, it defines what operating income is, it defines what net income is. And so what you'll find is anytime a public company uses a term that's a non-GAAP measure like EBITDA, they have to disclose the heck out of it. They have to describe exactly how they calculated it. And different companies calculate EBITDA differently. You know, some will have, and I have a list of 10 what we call add-backs. And so these are things that we spent money on during the year, but we pretend they never existed. And so maybe we had litigation settlement. Well, we don't view that as something that's going to happen every year, and so that's not, it's not a number that we focus on, so we take it out like it never happened. Again, this is to provide information to the investors in the way they want to see it. It's not that we're hiding anything, it's more that we're trying to normalize what the cash flows from the operations would be. But you can imagine the SEC doesn't want public companies just out there using a term like EBITDA that they haven't completely defined so that the investor can see exactly what it is that the filing is describing. And then the last of these hot topics that we have are that there are new standards coming out, and both of these have wide-reaching impact. So there's a new standard coming out on revenue recognition for private companies. It will go into effect in 2019, so there's plenty of time to implement it, but it redefines how revenue is recognized, sales, your top line of your P&L. And it has some pretty wide-reaching impacts. I won't go into them, but just as an example within franchising, it will completely change how we recognize our revenue. It will reduce what we've been showing historically from a revenue perspective. So franchising companies will be dramatically impacted by how revenue is going to be counted going forward. The other big standard that's coming out is related to leasing, and it also has a wide-reaching impact in that it will require things like building leases, where we've treated those as operating expenses in the past. Now those will be required to be put on the balance sheet, both as an asset and a liability. And so there, CFOs are starting to think about, well, I have covenants that I have to maintain from a debt perspective, and they tell me what ranges of assets and liabilities and perhaps net leverage I can have in my company. And now the whole basis of the balance sheet is going to change dramatically for putting leases on a balance sheet. And so now CFOs are having to start to think through their debt agreements and whether those need to be changed before these standards go into effect. Now, one of my favorite slides, here we talk about GAAP versus CRAP. I promise it's not what you think it is. So we've talked about GAAP. GAAP is generally accepted accounting principles. CRAP is cleverly rigged accounting principles. And so these are the types of things you can look for, in particular as you're reading footnotes, to see if there's any of these things that perhaps you see within a company as you're reading the financials. And so a company, as you think about like the Enrons, the Tycos, the WorldComs, they're all trying to accelerate revenues. And so revenue recognition is one of the key areas that SEC puts comment letters out. It's a key issue for review by auditors. Making sure that you get revenue recognition right is critical to the investor as well as to management. But you can understand why a company would want to accelerate revenues to report as sales things that occur before perhaps the rules, generally accepted accounting principles, would let them. Another area that has been abused in the past is judgmental reserves. And sometimes on an extreme side, these get called cookie jar reserves, going back to what we looked at on the balance sheet as accrual or accrued liabilities. And so if you're having a really good year, maybe you want to tone that down by putting an extra bonus accrual or an extra inventory reserve or other things that bring down your net income for the year, because it's just, you think it's too big and maybe the world can't continue in such a positive light. So let's tone it down, let's be a little bit more conservative. And then in the leaner years, companies have been caught taking those cookie jar reserves out to make results look better. And so that's an area where the SEC is really focusing on, is judgmental reserves, making sure that reserves that exist, I mean, there are good reasons for inventory reserves, warranty reserves, bonus accruals. All those things are critical. It's just a function of you have to be able to defend the value that is accrued in those reserves and not let them be arbitrarily increased or decreased based on the whim of management. Another area is deferring or capitalizing expenses. There we talked about what WorldCom was doing, taking phone bills and capitalizing them, and so putting them on the balance sheet rather than expensing them, and that's a way of deferring. Another area where companies get in trouble is related to intangibles. We talked about acquisitions, and so when you buy a company, you end up putting on the balance sheet the value of intangibles, like you create a value for customer lists and all the things that you bought that were more than the cash that you bought, more than the receivables, the inventory, the tangible things. You can really determine what the value is, but then you paid above that, you paid a premium for those acquisitions, and that premium is intangibles or goodwill. And so I put a couple of examples on here in that, a couple of companies that have been called out in the last few years. Rio Tinto had $14 billion worth of write-offs. And so in one case, they had a $38 billion acquisition that they did, and within a couple of years, they wrote off $11 billion of that value. So they paid 38 for something, and they ended up writing off 11 billion of that. In a different acquisition they had, they paid $4 $8.2 billion for it, and then ended up writing off $3 billion of that. So they said $14 billion in write-offs because they overpaid for acquisitions that they did. The value that they perceived was there wasn't really there. Another example that has really been in the news, HP bought a company, Autonomy, a few years ago, paid $10 billion for Autonomy. They ended up writing off $8.8 billion of that here in the last couple of years. So, you know, it's easy to get caught up in the excitement of buying a company and what it's worth and negotiating with that company so that both sides are getting what they perceive to be fair value. But then you come along 2 years later and things didn't work out quite the way you thought, and you end up with a $8 billion write-off, and that's true value. I mean, they paid $10 billion for this, and they flushed 8 of that. The HP CEO lost his job over that deal alone. And then another area that's subject to review and SEC would say manipulation is one-time charges. It's common for companies to try and say, hey, this expense that we had, these layoffs that we had, these plant closures that we had, they were one-time charges. They're not indicative of a cost structure going forward. And so you shouldn't penalize us for those expenses that we've incurred. And so the SEC pays close attention to the disclosure of those one-time charges, how they're characterized, and it's important to look for those types of things as you're reading the income statement. Now we'll shift a little bit more into the review and some of the real meat of things that we look for and read as CFOs, rather than just the numbers on the page of the 4 primary financial statements. And so here we get into metrics. And metrics really help us run the business. And in most cases, or in all cases, they come off of the numbers that we've been talking about, but it's an extra step. Sort of like when I was talking on the income statement of talking about margin percentages. The margin percentage isn't on the financial statement, but it can be derived and should be derived from the face of the financial statements. And so some key metrics that you guys should be looking at when you're reading financial statements, one is working capital. I'm always looking to see for a company, do its current assets exceed its current liabilities? Does it have positive working capital? If it has negative working capital, that may be an indicator or a red flag that there's a problem. In many cases, there are good explanations or reasons for negative working capital, but it's a starting point. If you see it negative, you want to dig into it more. And a positive working capital doesn't necessarily mean that the company is healthy or strong or good. Perhaps that company should have higher working capital. Another important thing for manufacturing companies is inventory turns. So how fresh is the inventory? How many times during the year do they go through their inventory? And so you can imagine this is a metric that varies dramatically across different types of company. If you're a food company, you want lots of turns. You don't want food sitting there getting stale, going gross. If you're a heavy manufacturing company, your turns are probably less. And how you calculate this is you take your cost of goods sold off of your income statement and you divide by your average inventory balance. And so maybe if you're a food company, you want inventory turns, say, between 12 and 24 times, and so that would be every 2 to 4 weeks. If you're doing heavy machinery, maybe it turns 3 times a year. And so, again, it's taking things in context. Day sales outstanding is almost always a critical calculation, critical metric, and this is how fast are you collecting your invoices. You get there by taking your trade receivables off of your balance sheet and dividing it by your average daily sales, sales divided by 365. And here what you often look for is something, invoices typically say due within 30 days. And so that means maybe you're really collecting in 45 to 60. In my experience, I want to see things in that 45 to 60. If you see things going out beyond 60, you really want to understand it. If you've got something collecting faster than 30, hey, that's a strong collection environment. Likely they're doing things well. But again, it's within context, within the industry, as compared to its competitors. Another important one is days payable outstanding. This we kind of hinted around when we were looking at the balance sheet, but this is how quick are you paying your invoices. It's calculated as your trade payables off your balance sheet, divided by the sum of your cost of goods sold and operating expenses, divided by 365, so an average daily expense number. And so what we saw in our balance sheet was accounts payable were growing dramatically. Is that a function of, are they extending their vendors? Are they paying them more slowly? Are they basically using accounts payable as a form of debt rather than having to borrow more money? And so again, invoices tend to be due about 30 days. It wouldn't surprise me to see days payable outstanding range in a 30 to 45 day range. If you see it going out beyond 45 days, you probably want to understand those trends and those things going on within the business. Other measurements and ratios that we look at a lot really depend on who it is that's looking at them. Investors may look at key metrics and ratios or different ones than management looks at. The industry as a whole may have specific things that are important to it, and then investment bankers or your day-to-day bankers may have a different perspective of, for a particular type of company, what ratios are important. You always want to have, particularly as internal management, what are your key operating metrics? It wouldn't surprise me if day sales outstanding was always on that list. Perhaps cash balance, inventory turns, some of the things we've talked about already. But it's really focusing for that business, what is important to it to be successful and successfully generating cash year over year. We've talked about EBITDA. For my business, EBITDA is the most important metric we measure every month. Sales are important. Sales don't matter near as much as EBITDA. If we are able to make up for a lack of sales by reducing expenses and we end up in a better place, our investors are happy with that because they measure the value of the company as a multiple of EBITDA. A number multiplied by EBITDA is what they perceive that we're worth. Other measurements and ratios that you want to be familiar with: your net worth is your asset minus your liabilities, thus your equity section. Quick ratio is your current assets divided by your current liabilities. Again, like working capital, that measures basically what the health of the business is over the next 12 months. Your debt to equity is your liabilities divided by equity. So, is the company being funded by equity? Is it being funded by debt? And is it subject then to interest rate swings? Return on equity. So what is your net income divided by equity? It's a percentage number. And so it's a measure of the health of your ongoing operations, just like return on sales. So what is net income as a percent of sales? And then you always, always, always have to pay attention as management to your debt covenants. That's the type of thing of, if you accidentally trip a debt covenant, your interest costs could double overnight, and you'll have your lenders calling you daily to ask what you're doing to get the business back to where they perceive it needs to be. And so then, as we think about different stages of company, what's important to, what's organizationally relevant to companies. Of the things that we've talked about, and we talked about, my background involves venture stage companies. It includes private equity, which is where I am now. It's included publicly traded companies. Growth percentage, margin percentage, day sales outstanding, key operating metrics, how much you're spending every year in CapEx. Those are things that are critical to companies in all stages. But then, like we talked about, you have to look at the context for the stage of company. If you're a venture stage company, you are focused on what your solvency date is. What that means is, at what date do I get to a point, and keep in mind, venture stage companies are generally burning cash every month. They're investing in the technology. They're not expected to be making a profit. They're expected to be losing money. And so solvency date is important because that is the date at which their liabilities, their debts exceed what they have. So the combination of cash and receivables and inventory. And so that's an important measurement from a standpoint of that is the date at which they need to know that they've got future funding coming in. Then the next thing that investors ask is, what's your fume date? And so at a solvency date, we know we have to put more money in. The fume date says no later than the fume date is when that cash needs to be in place. So the company can continue to operate. It can draw out and continue to run, but it has to know that that money is going to come in before the fume date, or else it's going to start missing payroll and other critical payables. From a private equity perspective, though, the world is totally different, and you're focused on what your earnings before interest, taxes, and depreciation is. You're focused on what your net debt is, because in a private equity environment, they tend to pay for companies when they acquire them with roughly half equity and half debt. And so they bring lenders in to help them pay for the company, and those lenders want to make sure that they're going to get their money back. And net debt as a multiple of EBITDA helps them know whether they're in a healthy range, or if EBITDA were to start to decline and that net debt number starts to go to a point where they're uncomfortable, they're going to be measuring that. And how they do that is through the debt covenants. And then if you're a publicly traded company, you're going to be focused on earnings per share. We talked about that earlier. You're going to be focused on your price earnings ratio. So what is the value of your stock divided by the earnings that you're generating? Perhaps you're focused on free cash flow, another measure of similar to cash provided from operations. And then perhaps you're focused on market value added or economic value added. Another important way to view the key operating metrics within the business are through dashboards. And so these are really critical to management. You won't see these generally from public companies in their 10K or other filings, but you'll see these within the company itself running the business. So these dashboards help management run the business, and it goes back to the key operating metrics that we talked about before. So what are the key things that were defined by the company that are important to it? And those may be industry specific or company specific. But if you're a manufacturing company, you want to understand how efficient is your line running, perhaps downtime, time between accidents, those types of things. If you're a services company, perhaps hours billed by utilization. If you're a restaurant company, day parts, probably inventory turns are important in manufacturing and restaurants, those types of things. You always want things like gross margins on your dashboards, perhaps your daily cash balance or month-end cash balance, some measurement of your collections like day sales outstandings, and then often bookings versus shipments versus revenue. The revenue that's generated is generally created by the shipments that occur. It may be more important for the company to understand what its bookings are, because that's a leading indicator of what future shipments will be and then what revenue will look like in the future. And so those are all things that are important to think about from a dashboard perspective. This is an example, and you won't be able to read the numbers specifically, but this is an example of a dashboard that I used at one of the companies that I was at that's private equity backed. The key thing here that I want you to see is it's comparative, like we were talking about before on the income statement. And so this shows from a last 12 months perspective what various metrics look like. It shows from a year-to-date perspective those same metrics. It shows for the month, just as a standalone month, what those metrics are, and then what the quarterly value of those metrics are. And so what we were measuring here, certainly gross revenue, and what the percent growth on gross revenue was from one period to the next. What was our gross profit and our gross profit margin? What was our adjusted EBITDA? Again, adjusted EBITDA was our measure of taking earnings before interest, taxes, depreciation, and amortization, but then taking out one-time expenses that we and our investors agreed were not indicative of how the business was running on a day-to-day basis. So the key thing there was that we agreed on it with our investors. It wasn't us trying to hide anything. It was we all agreed this was indicative of how the business is running. Since it was private equity backed, our interest coverage was an important measure to us because that was one of our debt covenants. Capital expenditures is almost always an important measurement. And then we get into other nuances. We have accounts receivable balances. We have various other things that we were measuring on a month-to-month basis. And then in this particular case, we were providing some forward-looking information to the investors as to what we expected next month's revenue and adjusted EBITDA to be. An alternative way, and I wasn't able to implement this with the dashboard we just looked at, but one that I love is a street light example. And so, it's easy for somebody to pick up one of these types of dashboards and say, where do I need to focus? Green is good. Yellow means it warrants concern or review. Red means we got a problem and we got to dig into this. And so you can quickly look at these types of dashboards and say, all right, my eye is going to go to the red areas. So particularly in this case, as we're looking at fund balances, our overall assessment and level compared to a 25% requirement, long-term trend, we really need to look at those areas. Need to look at long-term trend and expenses. But as a management team and perhaps as investors, we're probably not going to spend much time talking about revenue, the long-term trend, or franchise fees here because they're green. So let's really dig into areas where we need to focus. Let's focus our time on the areas in red. Let's spend some time talking about areas in yellow and what we're doing to address those. But let's count on management's doing the right things in the green areas. So we come back and think about this from a standpoint of direction provided from reviewing the financial statements. Financial statements that you're going to get in a Form 10-K or that you're going to provide, they're backward-looking information. How many people drive a car by looking in the rearview mirror? Financial statements are helpful. They help describe what's going on in the business, but projections are key thing within the business to drive the business forward. And so here, as we're looking at how we're going to improve the business, grow the business, the budget is a critical component of that, as well as keeping rolling forecasts. It's not enough to create an annual budget. As you're going through the year, you've got to continue to keep that updated. You've got to continue to say, okay, based on the things that have occurred over the course of the year, what do I see changing? Perhaps a big deal that we had built into the budget didn't happen, so now we need to adjust our rolling forecast to account for that. Does that mean we need to spend more in advertising to make up for it? Does it mean we need to reduce variable spending elsewhere? Do we need to cut back on travel, etc.? Other things that are forward-looking, what do we need to be doing about pricing? How do we need to be looking at profitability, usually by business lines or product lines, those types of things. We really need to be focused on cash flow and predicting cash flow. And this is a key deliverable that we have to provide to our investors weekly, is what are our projections for our cash flows over the next 90 days, and how much debt can we pay down in that 90 days, and how are we making sure that we're going to keep appropriate cash to run the business, but not so much cash that we're paying extra interest on that debt that we're holding, And so those weekly cash flows are important. You got to understand, when my payroll is due, how I'm going to make sure I cover payroll, what other expenses are due, rent comes up at the end of the month or beginning of the month, and have those all built in a detail forecast of what those cash flows are going to look like. Various other metrics that are often forward-looking as well, but also somewhat in the rearview mirror. Line of business profitability. You need to be looking at each of the lines of business, make sure they're holding their own. Each of them are generating profit as well as positive cash flow from their operations. You want to be looking at customer profitability. So each customer on a standalone basis, are they contributing to the health of the company? Is each customer with what they're paying adding to the cash flows of the corporation? Or do you have some customers that perhaps are overpaying and making up for others that you have to give a price concession to, and as a result they're really costing you money, and you have to rethink pricing as a result? Benchmarks. It's helpful to look at other companies perhaps in your industry, or even looking at historical trends and seeing, are we improving? Are we doing better than our competitors? Are we doing better than we've done in the past? Are we starting to see those things go down on us? Are we seeing negative trends, and do we need to be proactively adjusting and fixing for those? And then to some extent we've talked about net worth. Often, like I've described with fast lines, our valuation, our net worth, is determined by our investors as a multiple of EBITDA. And so those multiples will vary depending on industries. Some industries, a EBITDA multiple of between 4 and 8 is historical average. You get into perhaps some technology-enabled companies or technology firms, and you may end up with EBITDA multiples 10, 15, 20 because the future's so bright for what they're doing. And then you look at perhaps real estate-related companies, and cap rates are what they use to measure what their net worth is. And so as we come back and boil all this down, what are the takeaways? You have to read the whole story. You can't look at one thing by itself. You can't get drawn into the income statement and focus solely on net income. You can't just look at one statement. You got to look at them holistically. You've got to look at them together. Those financial statements are historical, not predictive, and so there you want to understand the best that you can the trends that are going on within the industry, and things that are perhaps in the MD&A as to what's going on within the industry and predictions that they're making to understand what the future holds. Certainly extra steps are needed to determine the health and the value of the company. That's calculating the metrics, looking at other measures, not just the ones that jump off the page at you. That said, it's not as hard as it looks. As you dig in more, as you ask yourself questions of, is this a company that's healthy? Is it growing? Is it increasing its margins? This will become more and more natural to you, and it will become second nature with practice. And so with that, those were the key things that I wanted to share with you from my perspective, and I will turn it back over to Professor Wheeler to wrap up.
Awesome. I'm so glad you did that, because you did a better job than I could have ever done. So thanks, everybody. And if you have any questions, send us an email, and be sure to copy to the graduate assistant on all emails to me. Thank you, and good night.